Silver just ripped higher while stocks stalled, and it happened right after the Fed decided to hold rates steady. In the last 24 hours, silver jumped more than 3% intraday, pushing back above the dollar level, while the S&P 500 faded and bond yields whipsawed. That divergence is not random, it's a signal. Because when silver starts outperforming equities during monetary uncertainty, it often means capital is quietly rotating into hard assets before the crowd catches on. We're also seeing the gold-silver ratio tighten and futures volumes spike at the same time, a combo that historically shows up before larger directional moves. So the real question is this just a short-term reaction, or the early stages of a much bigger metals breakout that most investors are about to miss? Welcome to Paper to Atoms, where we cut through the noise and focus on what the data is actually telling us about precious metals. This isn't a hype channel, and it's definitely not doom porn. Here we track real supply, real demand, real macro forces, and how they translate into price. While most financial media is obsessing over daily stock market swings, we're watching the slow but powerful shifts happening underneath the surface, in currencies, in physical metal flows, and inside futures markets, because that's where the early signals show up. If you want serious, research-driven analysis on silver, gold, and the monetary system, not recycled headlines, make sure you're subscribed to Paper to Atoms right now. And drop atoms in the comments so I know you're here for real market breakdowns, not just price cheerleading. All right, now let's get into what just happened after the Fed decision, because the reaction in silver tells a much bigger story than the headlines suggest. Let's break down exactly what happened, because the sequence matters just as much as the move itself. Ahead of the Federal Reserve decision, silver was trading near $1,000 hours, moving sideways as markets waited for confirmation on interest rate policy. Then the Fed announced a rate hold, signaling they're pausing tightening while keeping language cautious about inflation. Within minutes, bond yields dropped, the dollar wobbled, and silver caught a bid. From the post-announcement low near $1,000, silver surged to an intraday high around $1,000, marking roughly a 0.5% move in just hours. That's not typical random volatility. That's capital repositioning. Volume on the major futures exchanges spiked well above the recent daily average, showing this wasn't just retail traders, larger players were active. Now compare that to stocks. The S&P 500 initially popped on the no-hike news, but quickly faded, drifting back toward unchanged to slightly negative territory by the end of the session. That divergence, metals firm, equities fading, is something we often see when investors start questioning how strong the economy really is under the surface. Zoom out a bit. Over the past week, silver is now up roughly spot percent, while major stock indices are flat to down. Over the past month, silver has outperformed both the Nasdaq and the Dow, and on a year-over-year basis, silver is quietly closing the performance gap after lagging earlier in the cycle. The gold-silver ratio also tightened after the Fed decision, sliding from around toward Rakurino. That tells us silver isn't just being pulled higher by gold, it's leading. Historically, when silver leads during periods of monetary uncertainty, it signals rising demand for both monetary protection and industrial positioning tied to future stimulus expectations. Here's the deeper significance. Markets are starting to price in the idea that the Fed may be done tightening, but economic growth is still fragile. That's the exact environment where real assets begin to outperform financial assets. And if that rotation is just beginning, today's move might look small in hindsight. Now let's shift to the charts, because the technical setup in silver is lining up in a way we haven't seen in months. Right now, silver is pressing up against a key resistance zone near $1. This level has rejected price multiple times over the past several weeks, so the fact that we're back here with strong momentum and post-Fed volume matters. In plain English, buyers are testing the ceiling again, and repeated tests tend to weaken resistance. On the downside, initial support sits around $1,000, which lines up with the recent consolidation range and short-term moving averages. If silver pulls back but holds that zone, it would signal healthy consolidation rather than weakness. A deeper support level rests near dollars where previous breakout attempts stalled earlier this quarter. Looking at moving averages, the short-term trend has turned constructive. Price is now trading above the 20-day and 50-day moving averages, and those averages are beginning to curl upward. That's often the early stage of a trend transition. The longer-term 200-day moving average is still slightly above price, which means a decisive break above that level could trigger systematic and algorithmic buying. Many funds use that line as a signal to increase exposure. Momentum indicators are also shifting. The Relative Strength Index, RSI, on the daily chart has pushed back above the midline near 50 and is approaching the 60-65 zone, which historically marks strengthening bullish momentum without yet being overbought. On shorter time frames, momentum surged sharply after the Fed announcement, confirming that the breakout attempt has energy behind it. Volume is the other piece of the puzzle. The rally came with expanding volume, not shrinking volume. That tells us participation is broadening. When price rises on low volume, it's fragile. When price rises on strong volume, it's conviction. Now here's where it gets interesting. On the weekly chart, silver has been forming a broad consolidation pattern for months. Think of it like a coiled spring. Each pullback has been shallower, and each rally has pushed slightly higher. That kind of compression often resolves in a powerful directional move. Bullish scenario. Silver breaks and holds above dollars with sustained volume. That opens the door to a move toward the $0 region, where the next major resistance sits from prior highs. Bearish scenario, price gets rejected again and falls back below $0. That would likely send silver back into range-bound trading and delay the breakout thesis. So technically we're at a decision point, and the Fed pause just added fuel right as price tests the ceiling. Price moves get attention, but supply and demand determine whether those moves stick, and this is where the silver story gets structurally tight. Let's start with supply. Annual global silver mine production sits around 830 million ounces in a typical year, according to industry surveys. But here's the key detail most people miss. Roughly 70% of silver is produced as a byproduct of mining for copper, lead, zinc, and gold. That means silver supply doesn't respond quickly to higher prices. If silver jumps tomorrow, miners can't just flip a switch and produce more. Production decisions are tied to the economics of other metals. On top of that, ore grades at many primary silver mines have been declining over the past decade. Companies are moving more rock to get the same ounces, which raises costs and slows production growth. New large discoveries are rare, and permitting timelines for new mines can stretch 10 to 15 years, so supply growth is sluggish by nature. Now look at above-ground stocks. Exchange inventories, especially in Western vault systems, have been trending lower from their pandemic-era highs. COMEX registered silver, which is the category actually available for delivery against futures contracts, has fluctuated but remains well below peak levels from a few years ago. ETFs still hold large amounts of metal, but those holdings have also seen periods of drawdown when investor demand shifts physical bars out of trust structures. The point is simple. Visible, easily deliverable silver is not infinite. Now demand. This is where the pressure really builds. Silver is not just a monetary metal, it's a critical industrial input. Solar panel production alone consumes well over 100 million ounces per year, and that number has been climbing as global solar installations expand. Electric vehicles use significantly more silver than traditional internal combustion vehicles because of advanced electronics and power systems. Add in 5G infrastructure, consumer electronics, medical applications, and emerging technologies, and industrial demand has become one of the most stable and fastest growing components of the market. Investment demand adds another layer. During periods of monetary uncertainty, like when the Fed pauses and recession risks rise, retail investors tend to increase purchases of coins and bars. We often see this show up as rising physical premiums at dealers, even when futures prices are relatively calm. Institutional flows into silver ETFs can also accelerate quickly once momentum turns positive. Put it together, and many analysts estimate the silver market has been running a structural deficit, where annual demand exceeds annual mine supply by tens or even hundreds of millions of ounces. That gap gets filled by drawing down above-ground stocks, but those stockpiles are finite. Looking forward, industrial demand tied to energy transition policies is projected to keep rising, while mine supply growth remains constrained. That imbalance doesn't guarantee straight-up prices, but it does create a tight backdrop where any surge in investment demand can have an outsized price impact. And that's the fundamental fuel sitting under this Fed-driven move. Quick pause here, because we're halfway through and I want to make sure you're locking in the most important takeaway so far. Silver isn't just moving because of a headline. It's outperforming stocks at the same time the Fed is stepping back and the physical market remains structurally tight. That combination, monetary uncertainty plus supply constraints, is where metals historically start major runs. If this breakdown is helping you see the bigger picture, this is the perfect moment to subscribe to Paper to Atoms. We track these shifts continuously, and the early signals matter more than the loud headlines that come later. Also, tap the like button. It genuinely helps push serious metals analysis out to more people who are trying to understand what's really happening in these markets. Coming up, we're zooming out into the macro picture. Currencies, central banks, and the global forces that are quietly setting the stage for silver's next move. To really understand why silver reacted so strongly to a simple Fed hold, we need to zoom out to the bigger monetary backdrop, because this isn't happening in a vacuum. Start with central bank policy. The Federal Reserve is now walking a tightrope. Inflation hasn't fully returned to target, but economic growth is clearly slowing in key areas. Manufacturing surveys have softened, consumer credit stress has been rising, and interest-sensitive sectors like housing and commercial real estate are under pressure. By holding rates steady instead of tightening further, the Fed is signaling that financial stability risks are starting to compete with inflation risks. Historically, when the Fed shifts from aggressive tightening to pausing and eventually easing, precious metals begin to anticipate that pivot before it shows up in official rate cuts. Silver, being both monetary and industrial, tends to respond strongly because it benefits from expectations of future liquidity and long-term infrastructure spending. Now look at the dollar. The US dollar tends to strengthen during rate hikes and weaken when markets believe the hiking cycle is over. Even small cracks in dollar strength can act like a tailwind for metals, since silver and gold are priced globally in dollars. If the dollar index starts trending lower from here, it reduces the currency headwind that has capped metals rallies in the past couple of years. On the fiscal side, government deficits remain historically large. Servicing national debt at higher interest rates is becoming more expensive, which quietly increases pressure on policymakers to keep financial conditions from tightening too much. Over time, that dynamic often leads to policies that are supportive of hard assets, either through lower real rates, currency debasement, or both. Geopolitically, we're also in an era of increasing resource competition. Countries are prioritizing domestic supply chains for critical materials tied to energy transition and technology. Silver sits at the center of that because of its role in solar, electronics, and advanced manufacturing. Strategic stockpiling and long-term supply agreements by governments and large corporations can reduce the amount of metal freely circulating in global markets. Meanwhile, global trade fragmentation and geopolitical tensions encourage diversification away from single currency dependency. Central banks around the world have been increasing gold purchases in recent years, signaling a broader shift toward tangible reserve assets. While silver doesn't play the same official reserve role, it often rides the coattails of that broader hard asset reallocation trend. Put it all together: a pausing Fed, potential dollar softening, heavy fiscal burdens, and rising strategic demand for physical materials. That's not just a short-term news cycle, it's a macro environment that historically supports precious metals' outperformance over traditional financial assets. And silver just started acting like it knows that. Look, I need to be clear. I'm bullish on silver's longer-term trajectory, but that doesn't mean there aren't risks. In fact, acknowledging them is critical to staying disciplined in these markets. First, price risks. Silver could pull back sharply if the US dollar suddenly strengthens, or if equities regain momentum and investors rotate back into risk assets. A break below key support near dots and wires would likely trigger short-term selling, and volatility could spike quickly. Short-term swings of 10-15% are not unusual, especially around Fed announcements. Fundamental risks also exist. While mine supply is generally slow to respond, unexpected discoveries or accelerated production could temporarily ease supply pressure. Demand could also soften if industrial activity slows more than expected, or if technological substitutes reduce silver consumption in some applications. Market structure is another factor. The silver futures market remains highly leveraged. Margin calls or liquidity squeezes could temporarily drive prices lower, even if fundamentals remain tight. Paper market dynamics can sometimes create moves that don't reflect physical conditions. Another reason to watch both sides of the market. Balanced perspective. Short-term volatility doesn't negate the underlying supply-demand tightness we discussed earlier. Long-term, the structural deficit in silver production versus industrial and investment demand remains intact. The macro backdrop, Fed pause, fiscal stress, dollar trends, and geopolitical pressures still favors metals. Finally, a quick disclaimer. This is educational analysis, not financial advice. I don't know your personal situation, risk tolerance, or investment goals. Never invest more than you can afford to lose, and always do your own research. Acknowledging these risks isn't bearish. It's smart. It protects you from surprises while keeping you aligned with the bigger trend that silver may still be entering. Here's what I'm watching closely over the next few days and weeks, and what you should be tracking if you want to stay ahead in silver. Key price levels watch whether silver holds support at $2. If it breaks below, short-term weakness is likely. If it holds, the current rally may continue. Where to track? COMEX futures on CME Group or TradingView charts, COMEX inventory and ETF flows. Keep an eye on registered silver inventory. Drops below critical thresholds indicate physical tightness. Monitor silver ETF flows weekly. Rising accumulation signals investor confidence, while outflows could cap rallies. Source, CME Group, Kitco, Silver Institute. Dollar index movements. A declining dollar can give metals a tailwind. Key levels. Watch DXY near Suburzerg. A break could accelerate silver gains. Where to track? Investing.com or Fred. Macro announcements. Upcoming Fed statements, inflation releases, and industrial production data. Inflation surprises above expectations could push metals higher. Weak economic signals might trigger volatility in the short term. Physical premiums and dealer activity monitor premiums over spot at major bullion dealers. Rising premiums indicate growing physical demand and potential future shortages. Here's the interpretation guide. If silver holds support, volume confirms, and ETFs, physical demand remains strong. Bullish thesis intact. If silver fails support, dollar strengthens, and ETF flows reverse. Short-term caution warranted. Thesis checkpoints. Your bullish case remains credible as long as supply-demand tightness persists and macro conditions stay supportive. Breakdowns below structural support or easing of physical demand would warrant reassessment. Viewer homework. Track these 5 metrics yourself this week and see if the patterns match what the data suggests. You'll start noticing the subtle shifts before headlines catch up. This is how Paper to Atoms community members stay ahead of the curve, by combining real-time data, historical context, and technical confirmation. All right, if you made it this far, you're serious about understanding these markets, and that means you need to be subscribed to Paper to Atoms. Here's why. We're tracking these silver moves daily, and the next major shift could happen while other channels are still recycling yesterday's headlines. Subscribe now so you don't miss critical updates, and hit the like button. It literally takes a second but helps push this analysis to more investors who need to see it. Now I want to hear from you. Drop in the comments. Do you think silver breaks $dollars in the next week? Yes or no? Are you stacking physical silver, trading paper, or staying on the sidelines? If you've had any success in precious metals, maybe you timed a good entry, held through volatility, or simply stayed disciplined, share your story below. One sentence is enough. It motivates others and proves patience pays off. Here's the cliffhanger. The real question isn't whether silver will move tomorrow. It's what happens when delivery demand starts to exceed available supply. That's the event that historically triggers violent moves, and it's quietly approaching in physical markets. In the next video, I'll break down how institutional positioning, COMEX inventory stress, and global industrial demand could converge to create the next breakout, and how you can spot it early. You won't want to miss it. This is Paper to Atoms, where we turn research into reality. Stay sharp, stack wisely, and think clearly. I'll see you in the next one.